Okay, so we are ready to review for our first test. So we'll kind of go over, first of all, what to expect and what you can bring. And then I'll kind of go over, questions to review, multiple choice, and hands-on portion. So how the test is set up is we are covering chapters 8 and 9. So there will be some multiple choice questions. A lot of times the multiple choice is over like terminology or formulas and things like that. And so we'll go over those. And then you'll have hands-on questions too. So we'll go over, what hands-on to expect. They're obviously usually not as long hands-on as like your homework exercises because those get quite time-consuming. But you will have stuff that's similar, okay? As far as what you can bring, obviously bring a calculator. If you don't have a calculator, you can use the calculator on the computer. You'll want to put your phone away during the test. So we'll test in class. Put your phone away. You can bring paper and pencil for scrap paper too. And then for this test, you can have 1 page of notes front and back. Okay. So we'll kind of go over. Again, we did cover 2 chapters, and I know there's a lot of information. So I wanted to kind of go over what you should know for the test and just do some examples together too. So chapter 8 was probably the trickier chapter. We were dealing with accounting for uncollectibles or dealing with bad debt. So you do want to know the different methods. Okay, so for example, when we're dealing with multiple choice, obviously you want to know direct method versus allowance method. Okay. So we have 2 main methods, direct method and allowance method. Which method do we use if we're publicly traded? And we have to follow GAAP. Allowance method, good. So I would know, the allowance method for bad debts. So that was either using percent of sales or like an aging of accounts receivable. So for the allowance method, we could either do percent of sales or aging of accounts receivable. Those are the acceptable methods. The allowance method is the only acceptable method used if we're publicly traded and we have to follow GAAP. Okay. Direct method is fine. If you remember, that's when we just truly write off an account, and anytime we deem it uncollectible, we just write it off to bad debt expense. And that is fine, like if we're a smaller company and we don't have very many receivables, and if we're smaller, maybe we're a sole proprietor or partner or LLC or anything, private corporation even, anything that's not publicly traded can use the direct method, okay? So just kind of know there's 2 main methods and who can use them. Know when we're using an allowance method, an accounts receivable allowance method. So if we're doing the aging schedule, remember you have to consider what's in that allowance for doubtful accounts when you're doing your adjusting entry. So, and we'll do an example when we do hands-on stuff, but remember, whatever balance is in allowance for doubtful accounts, it can have a debit or a credit balance before the adjusting entry. So we're at the end of the period and we're ready to do our adjusting entry for allowance for doubtful accounts. You have to consider what's already in allowance for doubtful accounts, debit or credit, when you're doing that adjusting entry, okay? But only under the allowance method and only under aging, anything that does an accounts receivable method, okay? Percent of sales, if you're using percent of sales, you do not have to consider what's in allowance for doubtful accounts because it's going off of sales. It's not doing any calculations off of your accounts receivable, okay? So that's a biggie. So basically know on multiple choice again, after you've done your adjustments, that ending allowance for doubtful accounts balance is what you estimate to be uncollectible. That's your, what you estimate as uncollectible at the end of the year. So after you've done your adjusting entry, so you've done your aging schedule, you've adjusted your allowance for doubtful accounts, you did your adjusting entry, whatever's in allowance for doubtful accounts is what you deem uncollectible for that year, okay? And then just know the journal entry if it asks you, when you're doing an adjusting entry using an allowance method. Okay. What do I debit and credit? Just, you don't have to give me amounts because I didn't give you any, obviously, but if we've come up with an amount and we know what our adjusting entry amount is, what accounts do I debit and credit when I use an allowance method and I'm doing my adjusting entry?
Allowance for doubtful accounts
Mm-hmm.
and accounts receivable.
We won't do accounts receivable with the allowance method.
It is still bad debt expense.
Yes,
Okay.
yeah, you're going to debit bad debt expense and credit allowance for doubtful accounts.
That was the one.
For your adjusting entry, yeah, for your uncollectible, whatever amount, for your adjusting entry. So yeah, you debit bad debt expense and you credit allowance for doubtful accounts. That's when you're figuring out for the whole year, right? You're doing percent of sales or aging, whatever you're doing. And the difference, I mean, it's not on my notes, but the difference between that and the direct write-off, that's when you do accounts receivable.
Yeah.
So in a direct method, you would debit bad debt expense and credit their accounts receivable directly. But it wouldn't be an adjusting entry, right? You would just do that whenever you determine that it was uncollectible. So when we use the allowance method, it's always an adjusting entry.
That was all the Chapter 8 homework, right?
Yes, yeah, it sure was.
How do we know what numbers to use? I couldn't even get the numbers.
So we'll go over that when we get to the hands-on, which we're pretty close to.
Okay.
But yeah, we'll actually go over, well, how do I figure out what my adjusting entry is? Because that's a big one, right? Yeah. That's a big part of Chapter 8. And then another thing to know for Chapter 8 multiple choice is, and it kind of goes with the hands-on, so some of this will make more sense when we're going back through it. But remember, we always have a balance and allowance for doubtful accounts. It's a permanent account. So at the end, before we do our adjusting entry, allowance for doubtful accounts can have a debit or a credit balance, right? You guys remember that before we do our adjusting entry? Do you remember what it means? What does it mean if I had a debit balance?
So you're over what you thought?
Yeah, very good. You've written off more debt in the year than what you estimated. So very good. So a debit balance and allowance for doubtful accounts means that you wrote off more throughout the year than what you estimated. Okay. So it went to a debit. It has a normal credit balance, but if we wrote off more, so basically we underestimated our bad debt. So that's before adjustment. So a debit account balance before adjustment means that your write-offs were greater than what you estimated. After you do the adjusting entry, it will always be a credit balance. So as of December 31st, when you do your adjusting entry for that allowance for doubtful accounts, when you debit bad debt expense and credit allowance for doubtful accounts, allowance for doubtful accounts will always have a credit balance after the adjusting entry. That's your goal, really. Okay. That's the big stuff on the multiple choice. I would also just kind of, review, because we did talk about notes. So just know what maturity value of a note means. Do you remember what the maturity value of a note is? Like what amount that is?
That plus interest.
Yeah, the face amount plus the interest. Okay. So maturity value of a note is always the face amount plus the interest.
Whenever you're recording that, is that debit cash?
Mm-hmm.
There's always an interest expense?
Interest revenue in this case,
Interest
because
revenue.
it's money due to us. Yeah. Yeah.
And that's usually a credit account?
Yes, it sure is. Yeah. And we'll do one of those too. So really, again, on the multiple choice, understanding the different methods, direct method, small companies not GAAP compliant, allowance methods are GAAP compliant, understanding allowance for doubtful accounts and how its balance is handled. Any questions on multiple choice stuff so far? I would just know too that allowance for doubtful accounts is a contra asset account. I'd probably, kind of review that too. So if you remember, allowance for doubtful accounts is a contra asset account. So what it's doing is it's reducing our accounts receivable indirectly. Okay. So allowance for doubtful accounts is what we call a contra asset account. Okay. Well, let's go over the hands-on for Chapter 8 because I think that'll help you, with the multiple choice stuff too. It's always helpful to I say this blanket-wise too because sometimes I don't write everything down. Make sure you just review basic terminology in the chapter, like that allowance for doubtful accounts is a contra asset. I make the assumption, and it's a bad assumption on my part, that, if you know how to do it, all the hands-on, the terminology, but sometimes I see more wrong on the terminology than on the you'll be like, oh, I can do all of this, but I don't know what that word means. So, and I just, it's an assumption. It's a bad assumption on my part. So just review basic terminology too, like we're talking about maturity value and allowance for doubtful accounts and, things like that. And a lot of it we went over, but just to make sure I missed something. Okay, so hands-on stuff, important stuff. Of course, the big stuff is knowing how to use the different methods. So you will want to know how to journalize the direct write-off method. And we talked about that. When there's a direct write-off, and again, direct write-off is not GAAP compliant. So we're a small company, we have few receivables, and at any time during the year, we can just write off an account. So it's like May 1st, and we're like, Bob Smith's account is 120 days past due. We don't think we're going to receive it. I can write it off directly. Okay, so if I write off Bob Smith's account, what do I debit and credit with the direct write-off method?
Debit bad debt expense, credit accounts.
Perfect, yep. So I said May 1st, right? So under direct method, I would debit bad debt expense. And then just credit his account directly. Oops, I wrote that wrong. And for fun, we'll just say it was $5,000. Okay, so that's direct write-off. And then the other method, of course, is your allowance method. Okay, so allowance method, where you don't have percent of sales on there. But remember, percent of sales, you don't have to worry about what the balance is in allowance for doubtful accounts. But we're going to assume that we're using an aging of accounts receivable. Okay, so allowance method, we're using aging of accounts receivable schedule. And I don't think that one's even on the test, but you'll want to be able to do the adjusting entry. So if we do our aging schedule and they tell us, all the different percentages that are uncollectible, you guys can multiply that out and add it up. When they tell us, whatever you get there, if you remember, they're going to tell you, oh, we deem, let's just say, for example, we'll give an example under allowance. So say during the period, we think that 20,000 is uncollectible. Okay, we'll just make an assumption. I'm making this up. 20,000 is estimated uncollectible. If you remember, whatever we get, this is what we get from our aging schedule. This amount is our desired ending balance. Okay. So say we did our schedule, aging schedule, and 20,000 is what we came up with. That's our desired ending balance in allowance for doubtful accounts. Okay. So what that's saying is when I do my adjusting entry, when I'm finished, I want my balance to be 20,000. Okay, so we did our aging schedule and came up with 20,000. That's our desired ending balance for allowance for doubtful account. Remember, our goal is to calculate the adjusting entry. That's when we have to consider, is there a balance? There's always going to be a balance in allowance for doubtful accounts. So say there's an existing credit balance of 1,000. Say I have a 1,000 balance in credit in allowance for doubtful accounts, and I want my ending balance to be 20,000. What would my adjusting entry amount be?
19,000.
19,000, good. Remember, when we have an existing credit, we subtract our desired ending balance minus that credit to get our adjusting entry amount. Okay. So using an allowance method with an aging schedule, we have to consider what's in allowance for doubtful accounts, whether a credit or a debit balance, and we subtract if it's a credit balance.
Right.
What's my debit and credit then for my adjusting entry? What do I debit and credit?
You're gonna debit allowance for doubtful accounts? No?
You'll credit it.
Credit.
Yeah, credit it. So what will I debit?
It's still bad debt.
Yeah, bad debt expense, good. Under both methods, it's still a debit to bad debt expense. So again, this one's an adjusting entry, so it'd be at the end of the period. So I would debit bad debt expense. And I'm crediting my allowance for doubtful accounts. That 19,000 that I calculated. Okay. So in that case, my desired ending balance is 20,000. I know that's a credit. Allowance for doubtful accounts should always have a credit balance at the end of the, after the adjustment. I had an existing 1,000, so I subtracted. So I know I need to adjust allowance for doubtful accounts 19,000. So my adjusting entry is a debit to bad debt expense and a credit to allowance for doubtful accounts for 19,000. That's one of the bigger, harder concepts of this chapter. So are there any questions over this? So then, what would happen if the same desired ending balance, but I had an existing debit of 1,000? So before my adjustment, my allowance for doubtful accounts had a balance of 1,000 debit. So again, that means I underestimated and I wrote off more than I thought. What would my adjusting entry amount be then? 21,000. Good. We just add. So if we have an existing debit balance and allowance for doubtful accounts, we add. And then it's your same journal entry, it's just now 21,000. Any questions on that? Now we talked about, we get this debit balance because we've written off more than we estimated. As I go through the year under my allowance method, this was December 31st, and I start January 1. So allowance for doubtful accounts as of January 1 has that $20,000 credit balance. What happens if I still say, well, Bob Smith is not going to pay, and I want to write off his account? Under the allowance method, what do I debit and credit to write off an account? Okay, so I've estimated this year I'm going to write off 20,000 worth of debt, right? That's what this is saying. So how do I write off an account when this is my allowance for doubtful accounts balance? Well, what would you do to the accounts itself? Is accounts receivable. What would you do to write it off? Would you debit or credit it?
Debit.
Right.
Credit, yeah.
So you debit, balance.
Yeah.
And then you just list the accounts.
You got it. Perfect. Yeah, you are going to debit allowance for doubtful accounts and credit their account directly. Okay. So if we were writing off, so this is as of December 31st, which becomes January 1st balance, right? So we're in the next year. Okay. So let's just assume in this case, we're starting January 1st and we have a $20,000 balance here. And we think Bob Smith's $5,000 account is uncollectible. And say it's still May 1st. So we can write him off. We want to write him off. But we're going to debit allowance for doubtful accounts and then credit his accounts receivable. It would be the same. We'll just do the 5,000. So that's a write-off under an allowance method. Okay, so we estimated we're going to write off 20,000 all through the year. Well, we just wrote off 5,000. Okay. So that's how that allowance for doubtful accounts works. We estimate at the end of the year how much is uncollectible. Then throughout the next year, we write off accounts. We just keep writing off accounts. And every time we write off an account that we deem uncollectible, we're going to debit it. So we would just keep debiting all year. That's how, before we do our next adjusting at the end of the current year, allowance for doubtful accounts can have a debit or a credit balance. You know, say that was May 1st. Then, you know, maybe June 20th, we wrote off 2,000. And then August 30th, we wrote off another 5,000. You know, we would just keep writing it off. And so at the end of the year, of this current year, we're going to have a new balance. Okay. I could keep going. We'll just write off. Okay, so at the end, we have 20,000 minus all four of those, which is what, 18,000. Okay, well, that would be over here. I'm putting it on the wrong place. That would be 18,000 total. So we'd have a 2,000 credit balance. Kind of ran out of room there to illustrate. But that's how that balance changes in the year. So the whole point is we estimate how much is uncollectible, and then throughout the next year, we write off accounts out of that estimate. So their accounts receivable is getting credited each time, and allowance for doubtful accounts is going down. And then at the end of the year, we now have a balance of 2,000. We do our adjustment, you know, we calculate our schedule, we do our adjustment again, get a new balance, and we just keep going. Okay. So allowance for doubtful accounts is a permanent account. It just keeps a balance. It can have a debit balance or a credit balance. So it's kind of special, right? Because most of our accounts have like either a debit or credit ending balance. It can have either. Any questions on that? Okay. And the only other thing you want to know for bad debt, and then we'll talk about notes, is what we call the net realizable value of accounts receivable. Okay. Net realizable value of accounts receivable. So what I mean there is, I have this allowance for doubtful accounts that I've done at the end of the year, 21,000 credit, right? So my allowance for doubtful accounts balance was 20,000. I'm going back. I should have done this first, I guess. When we're looking at the end of the year, say it's December 31st, and we have accounts receivable. Accounts receivable has an ending balance of 300,000 debit. Okay. And allowance for doubtful accounts after the adjustment had an ending 20,000 balance. So all I'm talking about when I say net realizable value is I'm saying how much of my accounts receivable I actually expect to collect. So that's just your accounts receivable minus your allowance for doubtful accounts. Okay. So net realizable value equals accounts receivable minus allowance for doubtful accounts. So in this case, 300,000 accounts receivable minus 20,000 in allowance for doubtful accounts. My net realizable value is 280,000. That's what's reported on the balance sheet. So on the balance sheet, we'll see accounts receivable less allowance for doubtful accounts.
But that's not the adjusting entry?
No, it's just your actual balances after adjusting entries. Yeah. So this would be after we've done all adjustments before closing. Yeah, good question. So again, all net realizable value means is how much we actually think we're going to receive. And that's the amount we report on the balance sheet because we want it to be accurate, right? We don't want to include assets that we don't think we'll see. We don't want to include money we don't think we're going to collect. That's why we do all of this, like all of it. So that's the whole purpose behind this is we want to estimate out of all the accounts receivable in the year, how much do we think we're not going to collect? So that way on our balance sheet and our income statement, because bad debt expense is affecting our income, right? We take revenues minus expenses. So that way we're more accurately reporting our assets and our revenues. Okay. That's kind of the why behind everything. Any questions on any allowance stuff? All right. So the last part of chapter 8 dealt with notes. So you will want to know journal entries dealing with notes. So here we're talking about notes receivable, so money owed to us. So if you remember, we can issue a note for 2 reasons. We can issue a note for a past due account, and someone owes us money and they're like, hey, we can't pay. So we'll say, okay, we'll give you 90 more days, but we're going to charge you interest, okay? Or we can just issue a note for someone to borrow money, hard cash from us, okay? Either way, the difference between accounts receivable and notes receivable is what? What's the main defining difference between an accounts receivable and a notes receivable?
Notes long term?
Notes can be long term. So they usually are longer because our accounts receivable are usually only like 30 days. So what do we do with a note that we don't do with an accounts receivable?
Charge interest.
Charge interest. Good. So yeah, they're usually longer and we charge interest. So notes, we always charge interest on. I'm going to erase this stuff. Okay, so when we're dealing with issuing a note, the journal entry to issue a note depends on whether it's to write off an account or to issue for cash, right? But let's just say I issue a note for a past due accounts receivable. So I turn an accounts receivable into a note receivable. What do I debit and credit when I issue a note? So just the date of issue. So I'm just saying, hey, you have 90 more days to pay your account.
But what's the entry? Is what we're...
Yeah, what do you debit and credit?
Would you debit notes receivable?
Mm-hmm. You sure would. Yeah, you're going to debit notes receivable. Debit notes receivable. And what would I credit? It was for an account receivable. So what would I credit? I kind of gave you the answer. If we're doing it on an account, we're just switching it from an accounts receivable to a notes receivable. So I'm going to credit their accounts receivable. And we'll just make it 10,000. I'm going to think of an example that makes it easy. Okay. So we issued a note, let's just say it is March 1st. So on March 1st, we issue a $10,000 note to settle an account, okay? If we had given them cash, the only difference in this entry is cash would be debited, okay? Accounts receivable, or I'm sorry, cash would be credited. Notes receivable is always debited. You would credit cash if we were giving them cash instead of settling their account. Okay, so if we were issuing a note for cash, we would credit cash instead. So I'm going to put /cash just so you know it can be either one. And it'll tell you on account or cash. So now let's get into this note. So we issued a note on March 1st for $10,000. Say it is, I'm going to make this a 10% note for easy calculation. A 60-day 10% note. Okay, so in 60 days, they're going to pay us back the face value of $10,000 plus the interest, right? Well, first step, how do I calculate interest?
It's the amount times the percentage times the 60 divided by 360.
Perfect. So we take the face amount of 10,000 times the interest of 10% times the time, 60 days over 360. We use that banker's rule of days. Okay, so principal or face amount times interest rate times time and days. So
When we do
10,000.
interest rate, is that 0.1 or do we?
Yes, you can put it in either. You can either put it in your calculator as 10% or 0.1. Yeah. Does that make sense? I
Same
usually do.
thing.
Yeah. I usually do 0.1 because I don't like
I
messing
know
with
how
the
to do
percentage.
in my calculator.
Yeah. I don't like dealing with it. So yeah, 10,000 face amount times the 10% interest rate, which is an annual interest rate. That's why we multiply it by 60 over 360 to get 60 days worth of interest. So how much interest will accrue total on this note?
$166, $67.
Dang it, I did that, didn't I? I made it a bad one. I always do that, it never fails. I'm gonna round up to the nearest dollar. I'm like, oh, if I use 10%, right? Yeah. Sorry. You think I'd get an example and keep it, but I don't. Okay, so that's my interest. What's my maturity value?
Face plus that.
Very good. Yeah, maturity value is your face value or your, I think that, yeah, they call it face value, plus the interest. So maturity value is 10,000 plus the 167. Okay, so maturity value, what they're going to pay us back total, 10,167. Well, I wrote this on March 1st, and it's a 60-day note. So the next thing I need to figure out is when. When are they going to pay me, right? Come over here and do that. So for your maturity date, that's the date that they'll pay us. Well, it's a 60-day note, and it was written on March 1st. Well, how many days are in March? 31, yeah. Like, that sounds right. So 31 minus 1, so that's 30 days. How many days are in April? 30, right?
30.
Well, there we're to 60 days, right? So our maturity date would be April 30th. Okay, that would be 60 days. Oops. So when this matures on April 30th, they're paying me the full face value plus interest, right? On April 30th. So what do I debit and credit when they pay me that note? What do I debit?
Cash.
Cash, very good. And for how much?
The home maturity value.
Exactly, very good. We're going to debit cash the full maturity value, 10,116, 167. What do I credit? Notes receivable, perfect. And for how much?
Face amount,
The face amount, good.
face value.
So I credit notes receivable 10,000 because they paid it back to me. And then what else do I credit?
Interest.
Interest revenue in this
Yeah.
case, yeah, very good. Interest revenue. I earned $167 of interest revenue by issuing this note. So cash is debited the full maturity value. Notes receivable is credited the face value, and interest revenue is credited the interest. Any questions on that? Okay. Okay, any questions on chapter 8? A lot of material in chapter 8. You guys feel pretty comfortable with it? Okay. Okay, let's talk about chapter 9 then. So, most of chapter 9 is, or all of it, is dealing with long-term or tangible assets, right? Property, plants, and equipment, or what you'll be tested over anyway. That's always nice, right? So you'll want to understand the different depreciation methods, and then, you know, when we actually dispose or sell of an asset. And I left off any stuff on intangibles or minerals and, you know, all that stuff. So chapter 9, let me make myself some room here. Okay, so as far as multiple choice goes, you want to know the different parts, you know, when we're calculating depreciation. So, for example, you want to know the formula for straight line depreciation. What is the formula for straight line depreciation?
Cost minus residual value over useful life.
Perfect. Cost minus residual value divided by useful life. So straight line depreciation formula, cost minus residual value divided by useful life. Does anyone remember what another term for cost minus residual value is?
Appreciable. Something.
You're right.
Cost.
Depreciable cost, yeah. See, teamwork, right? So another way you could write that is depreciable cost divided by useful life. It means the same thing. So I'm just going to put like in parentheses here. That is depreciable cost. So cost minus residual value equals depreciable cost. And again, that depreciable cost just means the full amount you're going to depreciate that asset. Okay. Cost minus residual value. When you're done depreciating it, its value should be the salvage value or residual value. There's so many terms, sorry. Like I've taught out of different textbooks. They use different terminology. So I'm always like, oh no, they call it residual. Okay. Know what it means when we say estimated useful life. Well, what does that mean? Yeah, like just how long we're going to use it, how long it's going to be used in the business to help us earn profit. would also note, as far as multiple choice goes, because we'll get into some hands-on when we'll do all three methods, but as far as hands-on goes, know the difference between capital expenditures versus revenue expenditures. So here we were getting more into the maintenance of our assets, right? Like when we have equipment, we know it needs to be maintained or possibly even upgraded. So capitals versus revenue expenditures. So just know, you won't have to calculate it like you did on your homework or anything, but just know the difference. So like a capital expenditure is when we're improving the life or the value, okay? So capital expenditure is improving the life or the value of the asset. So that's when we did like a major repair, like put in a whole new engine, or we added something extra. And then a revenue expenditure is just a normal maintenance item. Oil change, spark plugs, you know, replacing tires even, stuff like that that's just normal wear and tear. So revenue expenditures are just expenses. Yes, sir.
How do we realize that? So with the it's just maintenance, repairs, expense, and cash, but how do we do the revenue one? Is it just the assets, so like the truck? Or maybe,
Good question. Yeah, if it's like improving the value of it, you know, like, or the, okay, I'm sorry. If it's actually something where it's like an extraordinary repair that's going to extend the life and the value of it, then that would be a debit to the asset itself, like truck or equipment. Mm-hmm. If it was just an improvement we made, but it's not really like extending the life, you know, if it's something like adding, I think they said like a hydraulic lift was the example they give, but adding like remote start or acting like a trailer hitch or trailer, something like that, then we would debit the accumulated depreciation. Yeah. You won't have to do that on the test, but yeah, it's a good question because they are kind of different. But yeah, capital versus revenue. So again, the capital one is just extending the life, extending. I'll get the word right eventually, right? I've been talking too long today. Extending the life or the value. And then, so that was, like I said, getting more into asset improvement. And then the last part of the chapter, oh no, that's not even really the last part. Just know, we talked about this already, fixed assets, they are tangible, you know, like land, equipment, buildings. We kind of talked about that. And we just use them to help us earn profits. So really, again, that's just getting into a simple definition, you know, what is a fixed asset? And then the only other thing with fixed assets on your multiple choice is just know how they're reported on the balance sheet. And, you know, just like the accounts receivable, where we took accounts receivable minus that allowance for doubtful accounts, assets are reported at their book value. Remember book value? So book value, what's the formula for book value?
Cost minus accumulated depreciation.
Perfect. Cost minus accumulated depreciation. This book value is the value reported on the balance sheet. Okay. So assets are reported on the balance sheet at their book value, cost minus accumulated depreciation. Remember, accumulated depreciation is a contra asset account too. So accumulated depreciation increases on the credit side. So it's really just a placeholder for the decline in value of your asset. So it's always at cost minus accumulated depreciation is your book value. And that's what's reported on your balance sheet. Okay. We're nearing the end, I promise, right? So that's what I'd go over for multiple choice. As far as your hands-on, So the big stuff will obviously be calculating depreciation. Okay, so we're going to go over the 3 methods. And then the last thing that we'll do is, the only other thing is calculating a gain or a loss when we dispose of an asset. Okay. So let's look at the different depreciation methods. Okay. So let's see. We want to calculate straight line depreciation first. So let's say we have equipment. I'm just going to write the parameters over here. Equipment that we purchased for $100,000. So that's the cost. Residual, we'll say it's $20,000. And our useful life is 4 years. Okay. So say we bought equipment. We'll make it easy on the first part. We bought it on January 1st. Make life easy. We bought it for $100,000, residual of $20,000, and its useful life is 4 years. So, we already have the straight line on the board, right? So we would calculate our depreciable cost. So we take cost minus residual. That equals 80,000. And we divide by the useful life of 4 years. See how I made that one easy at least? So our depreciation each year is 20,000. Okay. That's my depreciation expense. Okay. So straight line is pretty easy, right? Cost minus residual divided by useful life in years. That gets me my depreciation expense. What do I debit and credit to recognize that depreciation expense?
Depreciation expense and accumulated depreciation.
Very good. Yeah, I'm going to debit depreciation expense, 20,000, and credit accumulated depreciation, 20,000. And that's an adjusting entry at the end of the year. It doesn't matter which depreciation method we use. The only thing that'll change is the amount. You always debit depreciation expense and credit accumulated depreciation. Any questions on straight line?
So that's the same with all 3 methods?
Yeah, you'll have the same. The only thing that'll change is your numbers. Yeah. Got it.
Test, will there be where it's not like perfectly on January 1st?
Good question. Yeah, I would review like how to do partial year. You're like, dang it. Just straight line partial year. Okay. So on this one, for example, if we had purchased it April 1st, how many months would we have had it if we purchased it on April 1st?
8.
9, actually. That's where it gets a little tricky. You're going to count April.
Ooh.
Yeah. So yeah, be mindful of that. If you purchase it in the first half of the month, you count that month. So what I look at is I kind of go backwards. It makes more sense to me sometimes and say, well, I didn't have it January, February, or March. So if I didn't have it for 3, I had it for 9. That sometimes makes a little more sense. Okay. To me anyway, hopefully it does to you too, right? Sometimes what makes sense to me does not make sense to other people, according
What
to
if
my
we bought it
husband.
April 15th?
If you bought it like April, hopefully they won't give you like a 15th one, but if they give you like April 16th, then we would not count April. Anything in the second half of the month, we would just say, okay, we didn't own it for April.
Okay.
So then it would be 8 months.
So you don't do 8 months like days, just.
Yeah, just months.
Depending on if it was before the 15th or after the 15th?
Yeah,
Okay.
You got it. Yeah. Thankfully, you don't have to do days. That would suck, right? With notes, we have to do days. But yeah, with depreciation, you just go by the month of So anything in the first half of the month purchased, you count the month. If it's the second half of the month, you don't count it. So if this were April 1st, we would have had it for 9 months. So then remember, for partial year, you would just take your yearly times 9/12. Okay. Yearly times 9/12. Let's see. 20,000 times 9 divided by 12, 15,000.
And say if you were like selling it too, like in the middle of the year.
That's when you would have to update it. Yeah,
Same,
same thing. Yeah, you got
you
it.
gotta account for that.
That won't be on the test.
That won't,
No, but it's in your homework, I know. Yeah.
I was looking at the review. It's on review. Is all that due tonight, by the way?
Yes. I'll take it through tomorrow night, though.
Okay.
So, all right. Okay, so that would be our partial year. That would be partial if we purchased on April 1st. But your journal entry is the same, your straight line, your main formula is the same. Okay, so all that's changing is you have to multiply it by months over 12. Units of output. So with units of output, they'll give you like total production units or total units. Trying to think of an easy one. We'll say we expect to be able to produce 160,000 units total. Okay, 160,000 units total. So when we use units of output or units of activity method, if you remember, it's 2 steps, right? Step 1, we calculate the cost per unit, which is kind of the same as straight line. It's going to be your cost minus your residual. Only this time we're going to divide it by our useful life in output or units. Okay, so cost minus residual divided by total units. Okay, so 80,000 divided by 160,000, or 50 cents per unit. See how I actually was able to think of that one, right? So when you use units of activity method or units of output method, you calculate your cost per unit first. So very similar to straight line. Cost minus residual, but divide by the total units of production. So that gets us a cost of 50 cents per unit. So then my depreciation changes yearly. With straight line, it's the same, right? I do the same journal entry for 4 years. With this one, say in year 1, I produced 45,000 units. Well, then all you have to do is take those units times your cost per unit. Okay, should be what, 22,500? And that's my depreciation for year 1. Okay, so they'll give you all the stuff on the left. So step 1, calculate a cost per unit. Step 2, take whatever your production was that year and multiply it by the cost per unit. That one's pretty easy, right? Just if you have it written down. Any questions on that one? Okay, everyone's favorite, double declining balance, right? You won't have to calculate the last year, and you won't have to do partial year on double declining. So it won't be anything tricky, okay? It'll be the straightforward stuff. Let's see, that's this one's straight line. This one's units of activity. I'll probably move over here just so I don't run out of room. So we'll do 2 years worth just as a review. So double declining balance, DDB. Okay, using the same information, cost 100,000, residual 20,000, useful life 4 years. Remember, when you're doing your double declining, we don't consider that residual value. Okay. So step one is we calculate the straight line rate of depreciation. Step one, we calculate the straight line rate of depreciation. Does anyone remember how to do that?
The first step, or the.
Yeah, just calculating the straight line rate of depreciation. Do it. Yeah, 100% divided by the useful life. Which in this case is 4. So 100% divided by 4. So 25%. Very good. Yep, that's what we do next. Yep, you got it. So first we calculate the straight line rate, which is 100% divided by useful life in years. Okay, so 25%. Step two, we double that. So 25% times 2, 50%. So step two, we double the straight line rate. Step three, we actually calculate it. What do I do to calculate the depreciation for year one?
Cost times 3.
Yeah, we're going to do our cost for year one. It'd be cost times our double declining rate. So what we like to say though is it's book value. Book value times our DDB rate. Well, in year one, our book value is our cost, right? We haven't depreciated it all. So in year one, it's going to be 100,000 times 50%, or 50,000. Okay, so year one is 100,000 times 50%. What about year two? What's my new book value?
50,000.
50,000, good. It's your cost minus accumulated depreciation, right? Book value is cost of 100,000 minus accumulated depreciation of 50,000. So then we take 50,000 times 50%. So year two is 25,000. Year three would then be 100,000 minus a total of 75,000. Or you could do 50 minus 25. It'd be 25,000 times 50%, which would be 1,250. Okay.
And then if it's asking you, enter the thing for year two, it'd be
this one, yeah.
yeah, depreciable expense. Is that what it was?
Depreciation expense. Yeah.
Depreciation expense.
Yeah, that's a good question. So if they said calculate the depreciation expense for year two, that's what we did here. So yeah, be mindful of that when you're reading exam questions. Look at the date we purchased it. Look at, are they asking for year one? Sometimes they may say, oh, we purchased it on April 1st, but they want year two for straight line. So then you don't have to worry about partial year. So just, you know, be careful on the test. I always encourage students, like, take your time, look over, read the little fine print. Any questions on those three methods?
When you have to divide by 3, like 3
Yes.
years useful, what is your number that you use? Because I kind of think it's the wrong number every time.
If you have to divide by 3, what I would use is a 4-digit. Yeah, you should be able to do 0.3334 if it's a divide by 3. That should work. If it doesn't, then could be a problem. I thought they fixed that. We did have a problem with some of those on Cengage, but last semester, but they said they fixed it. So if you're still having troubles, email me through Cengage and I'll look at it. It won't be, I don't think the test has it like that. But yeah, if it's a divide by 3 years, then you get that 33.333333 or 6 years.
So you round it up even though it's 3.
Yeah.
Or you go up to 3, 4.
Yeah. But yeah, that one's a little tricky. Any other questions on those? Okay, so the very last thing is just being able to calculate a gain or a loss on disposal of the asset. So it's just remember, like when we say we wanted to get rid of this equipment. So we purchased this equipment in year 1 for $100,000. And then say we had, depreciated it for like 3 years, okay, under straight line. Say we depreciated it for 3 years under straight line. So if we did that, just to show you really quickly here, we purchased the equipment for $100,000. The accumulated depreciation for 3 years, we credited accumulated depreciation, $20,000. Okay. So say we're at the end of year 3 or the beginning of year 4. So we've depreciated this a total of $60,000, right? So when I'm getting rid of this, say I'm getting rid of it right now, the first thing I need to look at is my book value. Well, what's book value again? What do I take to calculate book value? Yeah, cost minus accumulated depreciation. Very good. So my book value is 100,000 minus 60,000, or 40,000. So you won't have to do all the journal entries and all of that when you're disposing of an asset, but you do need to know, you have to know the book value. When I'm disposing of an asset, I need to know the book value. So cost minus accumulated depreciation. So this equipment at the end of year 3 is worth 40,000 book value. If I sold it for 45,000, did I gain or lose? Gain. Yeah. So just be able to do that. You have to calculate book value first. And then if we sell it for anything above 40,000, we made a gain.
So
If
we
we
need another
sold it-
journal entry, sorry.
No. Just understand how gains and losses work. Yeah. So if I sold it for 39,000, I lost. If I sold it for 40,000, I broke even. Okay. So just be able to know a gain is any amount over book value. A loss is any amount under when we sell for less than the book value. So if they give you a bunch of information, you might have to calculate book value first and then be able to say it's a gain or a loss. But you won't have to do all the journal entry part. I basically just wanted you guys to understand gains and losses and book value. Book value is a really important concept because we need it, for our reporting purposes. We need it for double declining. We need it for, gains and losses. Okay. Oh, 10 minutes left. Any questions you guys have for me on the exam at all? So page of notes front and back. I should say this, right? I saw something on Facebook where someone said a note card and someone brought like a note card this big to an exam. So standard 8.5 and 11 by 11 page of notes. I don't care if they're typed or handwritten. If you can read 2-point font, go for it. And then, like I said, scrap paper, pen, pencil, your calculator, no phone, and we'll test in class on Thursday.
What did you say the assignments are
Oh, so they'll show as due tonight, but you'll still be able to access them. If you just always go through Canvas and just open it up through Canvas, and it should be open through tomorrow night.
So will we still get a late grade or?
No, it'll be full credit, yeah. I'll take homework pretty much up until the exam time, so it may even be open. If not, I'll double check. Sometimes it's even open until like we test at 11 a.m. So if you need to finish something up Thursday morning. Okay, well, y'all have a great day. You can get back into those adaptive study plans on Cengage. If you log into Cengage and go to study tools, if you want to do 8 and 9 again, it won't be graded, but you can go in and do those quizzes again, and those can be a good review too.
What about the homework? Will we turn it in if we can't?
You
access
should
that
be
again?
able to access it.
Oh,
Yeah, you
that's why I
should be able to
wasn't-
see.
That's why I wasn't turning it in yet, just because I wanted to
Yeah, once you submit it, you'll be able to go in and still see your report, so you'll still have access
see
to
all your
it.
answers and stuff. Okay.
Yeah.
That's what I was worried about, because that's what I used to study. with homework.
Yeah, it's a good study tool right there. Have a good one.